Let me tell you something that has made me billions of dollars over my career. The best time to buy is when everyone else is selling. The best opportunities come wrapped in fear, wrapped in pessimism, wrapped in headlines screaming that the world is ending. When blood is running in the streets, when investors are capitulating, when nobody wants to touch something with a 10-foot pole, that is exactly when I start getting interested. I've built my entire career on this principle: buying when others are terrified, going all in when the consensus says you are crazy, finding value in the rubble that everyone else has abandoned. And right now, I am seeing opportunities in 3 beaten-down sectors that remind me of some of the best trades I've ever made. I know what you are thinking. These sectors are beaten down for a reason. There are real problems, real challenges, real reasons why investors have fled. And you are right. But here is what most people don't understand. The market doesn't price assets based on whether things are good or bad. The market prices assets based on expectations when everyone expects the worst. When all the bad news is already priced in, you don't need things to get good for the stocks to go up. You just need things to get less bad. Let me take you back to 2009, because that is when I made the trade that defined my career. The financial system had just collapsed. Lehman Brothers had gone bankrupt. AIG had been bailed out. Banks were failing left and right. The stock market had fallen over 50% from its highs, everyone. And I mean everyone thought the world was ending. I looked at the situation and I saw something different. I saw the government throwing everything it had at the problem. The Federal Reserve was cutting rates to zero. They were buying bonds, injecting liquidity, doing whatever it took to stabilize the system. The Treasury was injecting capital into banks, guaranteeing deposits, backstopping the financial system. The government had made it clear that they would not let the system collapse. So I went all in on financials. I bought Bank of America. I bought Citigroup. I bought every beaten-down bank stock I could get my hands on. People thought I was insane. These stocks had fallen 90%. Some of the smartest investors in the world were predicting nationalization, wiping out shareholders completely. But I did the math. The government's actions were going to work. The banks had more value than zero. And if they survived, which I believed they would, the stocks would have to go up dramatically from their depressed levels. It wasn't complicated. It was just contrarian. I was buying what everyone else was selling. That trade made me about $7 billion in a single year. $7 billion. It was one of the greatest trades in hedge fund history. Not because I was smarter than everyone else. Because I was willing to buy when everyone else was terrified. Because I understood that extreme pessimism creates extreme opportunity. That same principle is guiding my thinking today. I am looking at sectors that have been absolutely crushed. Sectors where investors have given up. Sectors where the headlines are uniformly negative and nobody wants to touch them. And I am finding opportunities that remind me of financials in 2009. The first beaten down sector I am going all in on is China. Chinese stocks have been absolutely decimated over the past few years. The major Chinese tech companies have fallen 60, 70, 80% from their highs. The Chinese market as a whole has dramatically underperformed the rest of the world. Investors have fled in droves, pulling money out of Chinese funds and ETFs at a record pace. The reasons for the sell-off are well known. The property crisis has shaken confidence in the Chinese economy. Evergrande and Country Garden and dozens of other developers have defaulted, threatening a broader financial crisis. The regulatory crackdown on technology companies spooked investors who worried that the government would destroy private enterprise. Geopolitical tensions with the United States have raised fears of sanctions, tariffs, and even military conflict over Taiwan. COVID lockdowns damaged the economy and raised questions about government competence. All of these concerns are legitimate. I am not dismissing them. But here is what I am seeing that the market is missing. First, the Chinese government is pivoting hard towards stimulus. They've cut interest rates, they've reduced reserve requirements for banks, they've eased restrictions on property purchases, they've announced support for the stock market. They've signaled in every way possible that stabilizing growth is now the top priority. This is not a government that is going to let the economy collapse. They have the tools and the willingness to support growth. and they're using them. Second, the valuation is absurdly cheap. Chinese tech companies are trading at single-digit price to earnings ratios, companies with dominant market positions, with billions of users, with growing revenues, trading at valuations that would be considered cheap for a slow-growth utility company. The market is pricing in a disaster scenario that I don't think is going to happen. Third, the positioning is extremely negative. Everyone who is going to sell has already sold. Hedge funds are underweight China. Institutional investors have reduced exposure. Retail investors have fled. When positioning is this negative, when everyone is already bearish, the asymmetry flips in your favor. Any positive surprise, any news that is less bad than expected, can trigger a sharp rally as investors scramble to cover short positions and rebuild exposure. I've seen this setup before. I saw it in financials in 2009. I saw it in European stocks in 2012 when everyone thought the Eurozone was going to collapse. I saw it in energy stocks in 2020 when oil prices went negative. Every time, the extreme pessimism created extreme opportunity, and every time, the recovery was faster and more powerful than anyone expected. Now, I am not saying China doesn't have problems. The property sector is genuinely troubled. The demographic picture is challenging. Geopolitical risks are real. But the market is already priced in a catastrophe. What happens if we just get muddling through? What happens if the stimulus works well enough to stabilize growth? What happens if the regulatory crackdown eases and the government starts supporting the private sector again? I think Chinese stocks could double from current levels without anything particularly good happening. Just less bad would be enough. And if things actually improve, if the stimulus gains traction and confidence returns, the upside could be much larger. I am buying Chinese tech stocks directly. I am buying Chinese ETFs. I am adding exposure across the board because I think the risk-reward is as attractive as anything I've seen in years. Let me give you more specifics about why I am so bullish on China right now. Look at the individual companies. Alibaba, the dominant e-commerce platform in China, is trading at about 8 times earnings. 8 times. This is a company with hundreds of millions of active users, with dominant market share in Chinese e-commerce, with a fast-growing cloud business, with expanding international operations. In any normal environment, this company would trade at 20 or 30 times earnings. The discount is staggering. Tencent owns WeChat, which is the super app that over 1 billion Chinese use for everything from messaging to payments to shopping to gaming. They own the largest gaming company in the world. They have investments in countless other technology companies. They're trading at historically low multiples because investors are afraid of regulatory risk. But the regulatory crackdown has paused. The government has signaled it wants to support the private sector. The worst is behind us, not ahead of us. JD.com, PDD Holdings, Baidu, NetEase, the list goes on. Quality companies with strong competitive positions, trading at fractions of their historical valuations. The market is treating them like they're going out of business when they're actually growing revenues, and in many cases growing profits. I also want to address the geopolitical risk, because I know that is the main concern for many investors. Yes, there is tension between the United States and China. Yes, there is risk around Taiwan. Yes, there could be sanctions or other actions that hurt Chinese companies, but I think this risk is already priced in. And then some, the market is pricing these stocks as if conflict is imminent and certain. I don't think it is. The economic interdependence between the United States and China is enormous. American companies depend on Chinese manufacturing. Chinese companies depend on American technology. Neither side wants to blow up this relationship entirely. There will be friction, there will be tariffs, there will be restrictions in certain sectors. But total economic war is not in either side's interest. And even if tensions escalate, the Chinese domestic market is enormous. These companies can thrive serving Chinese consumers, even if they're cut off from American markets. The billion-plus consumer market in China is big enough to support massive businesses, even in a decoupling scenario. The timing feels right to me. The policy pivot is underway. The stimulus is being deployed. The regulatory uncertainty is fading. The valuation is extreme. The positioning is extreme. All the pieces are in place for a major rally. And when China rallies, it can rally hard and fast. Investors who wait for confirmation will miss the move. The second beaten down sector I am going all in on is small cap value stocks in the United States. This might seem like an odd choice because the overall U.S. stock market has done well. The S&P 500 has been hitting new highs. The mega cap tech stocks have been on fire, but beneath the surface, there is a massive divergence. Small cap stocks, particularly small cap value stocks, have dramatically underperformed. Let me give you some numbers to illustrate how extreme this divergence has become. The Russell 2000, which tracks small cap stocks, has gone essentially nowhere over the past 3 years, while the S&P 500 has risen significantly. Small cap value stocks have done even worse. The gap between large cap growth and small cap value is at historic extremes, wider than it was during the dot-com bubble. Why has this happened? Several factors have combined to crush small caps. Rising interest rates hurt small companies more than large companies because small companies are more dependent on borrowing. They don't have the cash piles that mega caps have accumulated. They can't issue bonds at favorable rates. When rates rise, their financing costs rise, their valuations fall, and their stocks suffer. The dominance of passive investing has also hurt small caps. As money flows into index funds, it disproportionately goes to the largest companies because market cap. Weighted indices put more money into bigger companies. This creates a feedback loop where money flowing into index funds pushes up large cap stocks, which increases their weight in the index, which means more money flows into them. Small caps get left behind. The concentration of investor attention on AI and technology has sucked capital away from small caps. Everyone wants to own NVIDIA and Microsoft and the Magnificent Seven. Nobody wants to own small industrial companies or regional retailers or niche service businesses. The glamour stocks get all the attention and all the capital flows. But here's what the market is missing. Small cap value stocks are trading at valuation levels that have historically preceded huge outperformance. The price-to-book ratio, the price-to-earnings ratio, the price-to-sales ratio, they're all at levels that in the past have marked major bottoms for the asset class. Whenever small cap value has gotten this cheap relative to large cap growth, the subsequent returns have been exceptional. History shows this clearly. After the dot-com bubble, small cap value outperformed large cap growth by over 10 percentage points per year for nearly a decade. The mega cap tech stocks that everyone loved in 1999 went nowhere for years, while the small cap value stocks that everyone ignored compounded steadily. Mean reversion is a powerful force, and the current divergence is extreme enough that mean reversion alone could drive significant outperformance. There is also a fundamental case for small caps beyond just valuation. Small companies are more tied to the domestic economy. They benefit more from reshoring, from infrastructure spending, from policies that favor American manufacturing. The political environment has shifted towards supporting domestic production, and small cap industrials and manufacturers are direct beneficiaries. Small caps also benefit from economic growth. If the economy avoids recession, if growth continues, small companies will see their revenues and earnings improve. They have more operating leverage than large companies, meaning their earnings can grow faster when conditions improve. A soft landing scenario, which is looking increasingly likely, is very good for small caps. And if interest rates start to come down, which they eventually will, small caps will get a double boost. Lower rates reduce their financing costs and increase their valuations. The same sensitivity to rates that hurt them on the way up will help them on the way down. I am buying small cap value ETFs. I am buying individual small cap stocks that trade at deep discounts to their intrinsic value. I am building exposure to a part of the market that everyone has abandoned, but that I think is poised for significant outperformance. Let me tell you about some specific opportunities I am finding in small cap value. There are industrial companies trading at 6 or 7 times earnings with solid balance sheets. growing revenues, and dominant positions in niche markets. These aren't speculative startups. They're established businesses that have been around for decades, generating consistent profits, paying dividends, buying back stock. The market just doesn't care about them because they're not AI companies. There are regional banks trading at huge discounts to book value. Yes, the regional banking crisis of 2023 scared investors. Yes, there are real concerns about commercial real estate exposure, but the surviving banks are actually in stronger positions. Now, the weaker competitors failed or were acquired. The survivors have tightened underwriting, raised capital, and improved their risk management. They're trading at 50 or 60% of tangible book value when they should trade at or above book value. There are energy companies, small exploration and production companies, trading at 2 or 3 times cash flow. They're generating enormous free cash flow at current oil and gas prices. They're paying down debt, buying back stock, paying special dividends. But the market treats them like oil is going to zero tomorrow. The valuation makes no sense, given the cash flows these businesses are producing. There are retailers trading at 3 or 4 times earnings who have survived the Amazon apocalypse. They've adapted their business models. They've right-sized their store footprints. They've built out e-commerce capabilities. The survivors are actually good businesses now, but they're valued like they're going bankrupt next year. The common thread is that these stocks are cheap on any metric. They're ignored by most investors, and they would benefit significantly from a broadening of market participation. When money stops flowing exclusively into mega-cap tech and starts spreading across the market, these stocks will finally get their day in the sun. I also want to emphasize the historical precedent here. The current gap between large cap growth and small cap value is at extreme levels. We've only seen gaps this wide a handful of times in market history. Every single time, the subsequent decade saw small cap value dramatically outperform. Every single time, the mean reversion was powerful and persistent. I am not saying history repeats exactly, but the setup is as good as it has ever been for small cap value. The third beaten down sector I am going all in on is clean energy. Solar stocks, wind stocks, electric vehicles, supply chain stocks, battery companies, they've all been absolutely crushed over the past 2 years. The clean energy ETFs have fallen 50, 60, 70% from their highs. Companies that were market darlings during the green energy boom of 2020 and 2021 are now trading at levels that suggest they're going out of business. The reasons for the sell-off are straightforward. Interest rates rose dramatically, which hurt capital. Intensive industries like clean energy that depend on cheap financing. Supply chain problems, increased costs, and delayed projects. Competition intensified, particularly from Chinese manufacturers who flooded the market with cheap solar panels. Policy uncertainty in the United States created doubt about the future of clean energy incentives. And the initial euphoria about clean energy gave way to more realistic assessments of the timeline and challenges involved in the energy transition. All of these headwinds are real, but here's what I think the market is missing. First, the Inflation Reduction Act in the United States provides massive long-term support for clean energy. We're talking about hundreds of billions of dollars in tax credits, subsidies, and incentives over the next decade. This isn't going away, regardless of who wins elections. The investments are being made in Republican districts as much as Democratic ones. The jobs are being created across the political spectrum. The policy support is durable. Second, the underlying demand for clean energy is only growing. Corporations have made net zero commitments that they need to fulfill. Utilities are building renewable capacity to meet regulatory requirements and customer demand. Countries around the world are setting increasingly ambitious climate targets. The energy transition is not optional. It is happening whether investors are enthusiastic about it or not. Third, valuations have reset dramatically. Companies that were trading at 50 or 100 times revenue are now trading at 1 or 2 times revenue. The speculation has been washed out. The tourists have left. What remains are real businesses generating real revenue with real growth prospects, trading at prices that assume they're going out of business. Fourth, the cost curves for clean energy continue to improve. Solar panels are cheaper than ever. Battery costs have fallen dramatically. wind turbines are more efficient, the fundamental economics of clean energy get better every year. The temporary headwinds from interest rates and supply chains obscure the long-term improvement in the underlying technology. I've done this analysis before with other beaten-down sectors. I look at the long-term fundamentals. I look at the policy support. I look at the valuations. And I ask myself, what is already priced in with clean energy? I think total failure is priced in. I think the market is assuming that these companies won't grow, won't generate profits, won't survive. And I think that is wrong. The survivors in the clean energy space will be enormous companies. The energy transition requires trillions of dollars of investment over the coming decades. The companies that provide the equipment, the technology, the services for this transition will capture a share of that spending. At current valuations, you are getting these future cash flows for almost nothing. I am buying solar companies, I am buying battery companies, I am buying companies involved in grid infrastructure and energy storage. I am building a diversified position across the clean energy sector because I think this is one of the most asymmetric opportunities in the market. Let me be more specific about what I am seeing in clean energy. Solar panel manufacturers have been crushed, with some down 80 or 90% from their highs. The Chinese dumped cheap panels on the market. Margins collapsed, and investors fled. But tariffs are going up on Chinese solar panels. Domestic manufacturing is being incentivized through the Inflation Reduction Act. The companies that survive this shakeout will have less competition and better margins on the other side. Battery technology companies have been destroyed, despite the fact that batteries are essential for the energy transition. Every electric vehicle needs batteries. Every grid-scale energy storage project needs batteries. The demand is going to be enormous over the coming decades. But the stocks have fallen so far that the market is pricing in no growth at all. You are getting future demand growth for free. Utility-scale solar and wind developers are trading at discounts to the value of their existing projects, meaning you could theoretically buy the company, sell off all the operating projects, and pocket the difference. The market is assigning zero value to their development pipelines, zero value to the billions of dollars of projects they have under construction or in development. That makes no sense. Grid infrastructure companies are essential for the energy transition, regardless of whether you are bullish on solar or wind or batteries or nuclear or anything else. The grid needs to be upgraded. Transmission lines need to be built. Transformers need to be installed. This is a bottleneck for everything else. And these companies are trading at reasonable valuations with long runways for growth. I've studied the IRA in detail. The tax credits are structured to provide certainty for 10 years. Companies can plan around them. Projects pencil out with these credits included. The investment is flowing into domestic manufacturing, into project development, into the entire clean energy supply chain. This isn't speculative. The money is being deployed right now. The key insight is that the stocks are priced for the clean energy transition to fail. But the transition isn't optional. It is being mandated by governments around the world. It is being demanded by corporations who have made net zero commitments. It is being driven by economics, as renewable energy becomes the cheapest source of new power generation in most markets. The transition is happening. The only question is which companies will capture the value. Now, let me step back and explain my overall framework for investing in beaten-down sectors, because the framework is more important than any individual idea. The key insight is that markets overshoot in both directions. When things are going well, optimism takes over, prices rise above fair value, and investors extrapolate good times indefinitely. When things are going badly, pessimism takes over. Prices fall below fair value, and investors extrapolate bad times indefinitely. Neither extreme is sustainable. Prices eventually revert toward fair value. I learned this lesson the hard way early in my career. I was working at Goldman Sachs in the late 1980s, and I watched how the market overreacted to both good and bad news. Stocks would get too expensive when the story was good, too cheap when the story was bad. The gap between price and value was where the opportunity lived. When I started my own fund, Appaloosa Management, I built the entire strategy around this insight. Find assets that are too cheap because of excessive pessimism. Buy them wait for sentiment to normalize, sell when prices reflect fair value or become too optimistic. Repeat, it sounds simple. It is not. The hardest part is psychological, buying beaten. Down assets means buying things that are falling in price. It means buying things where the news is bad. It means buying things where everyone tells you are wrong. It means looking at your portfolio every day and seeing red while everyone else is seeing green in the popular trades. Most investors can't do this. They're wired to follow the crowd. They feel safe when they own what everyone else owns. They feel anxious when they own what nobody else wants. This psychological bias is what creates the opportunity. If everyone could easily buy beaten down assets, they wouldn't stay beaten down. The trick is identifying when pessimism has gone too far, when the bad news is fully priced in, when everyone who is going to sell has already sold, when the marginal seller has been exhausted and the only direction is up. There are several signals I look for. First, valuation extremes. When assets trade at historic lows relative to earnings, book value, or other fundamental metrics, that is a signal that pessimism may have gone too far. Valuation provides a margin of safety. Even if things get worse, you haven't paid much for the assets. Second, positioning extremes. When hedge funds are maximally underweight, when institutions have reduced exposure, when retail investors have fled, that is a signal that selling pressure is exhausted. Markets need buyers and sellers to move. When everyone is already on one side of the trade, the path of least resistance is the other direction. Third, sentiment extremes. When magazine covers are proclaiming the death of an asset class, when pundits are unanimously bearish, when nobody has anything positive to say, that is often a contrarian indicator. The crowd is usually wrong at extremes. Fourth, policy response. When governments and central banks are actively trying to support an asset class or an economy, that is a powerful tailwind. Governments have enormous resources. They can change the rules of the game. Fighting the government is usually a losing strategy. All three sectors I've discussed today show these characteristics. China has extreme valuations, extreme positioning, extreme sentiment, and a government actively trying to stimulate growth. Small cap value has extreme relative valuations, extreme relative positioning, and an improving fundamental backdrop. Clean energy has extreme absolute valuations, exhausted selling pressure, and massive long-term policy support. None of these trades are without risk. China could have a hard landing. Small caps could underperform for longer. Clean energy companies could go bankrupt. I am not saying these are sure things. Nothing in investing is a sure thing. But the risk-reward is asymmetric. The downside is limited because so much bad news is already priced in. The upside is substantial because prices could rise dramatically on just modestly better news. That asymmetry is what I look for. Situations where I can make multiples of my money if I am right, while losing a manageable amount if I am wrong. This approach requires patience and conviction beaten. Down sectors don't turn around overnight. You have to be willing to hold positions that look wrong for months or even years before they work. You have to be willing to look stupid while everyone else is making money in the popular trades. You have to have the psychological fortitude to buy more when prices fall further instead of panicking and selling. I've been doing this for decades. I've learned that the uncomfortable trades, the trades that make you queasy, are often the best trades. If it feels easy, if everyone agrees with you, you are probably late. The big money is made by being early and being right, even when being early means being wrong for a while. Let me share one more thought about risk management, because position sizing matters as much as idea selection. When I go all in on beaten down sectors, I don't mean putting my entire portfolio into one bet. I mean taking meaningful positions that will make a real difference to my returns, if I am right. A 1% position that doubles is nice but not transformational. A 10% position that doubles changes your year. But I also diversify within the theme. I don't buy just one Chinese stock. I buy a basket. I don't buy just one small cap value stock. I buy a diversified portfolio. I don't buy just one clean energy company. I spread the risk across the sector. This way, individual company failures don't destroy the trade, even if the overall thesis is correct. I also manage the overall portfolio risk. These three sectors are correlated in some ways. They're all beneficiaries of lower interest rates. They're all contrarian bets against consensus positioning. If I am wrong about the macro environment, I could be wrong on all three simultaneously. So I balance these positions against other holdings that would benefit from a different scenario. The goal is to be positioned for significant upside while limiting downside to manageable levels. You want to survive being wrong so you can be around to be right. You want to have the staying power to hold positions through volatility without being forced to sell at the worst possible time. These three beaten down sectors represent my highest conviction ideas right now. China, because extreme pessimism has created extreme value in quality companies. Small cap value, because the divergence from large cap growth has reached historic extremes. Clean energy, because the sell-off has created an opportunity to buy long-term growth at distressed prices. I've made my career buying what others are selling, going against the crowd when the crowd has gone too far. Right now, the crowd has given up on China, on small caps, on clean energy, and that is exactly why I am going all in. The trades that feel the most uncomfortable often turn out to be the most profitable. These trades are uncomfortable. The headlines are negative. The price action has been painful. Everyone says I am wrong. That is exactly how the best trades feel at the beginning. And I've learned to trust that discomfort, to lean into it, to use it as a signal that I might be onto something. This is how fortunes are made, not by following the crowd, but by having the conviction to go against it when the odds are in your favor. Not by buying what is popular, but by buying what is hated. Not by waiting for confirmation, but by acting when the risk-reward is asymmetric. That is why I am going all in on these three beaten down sectors. And that is why I think investors who do the same will be very happy they did in the years to come. Let me leave you with one final thought. The best trades of my career have all felt uncomfortable at the beginning. When I bought financials in 2009, my stomach was churning. When I bought European stocks during the Euro crisis, everyone thought I was insane. When I bought energy stocks, when oil went negative, the headlines were apocalyptic every single time. The discomfort was the signal that I was onto something. The comfortable trades, the trades where everyone agrees with you, those rarely make you real money. By the time something is obvious, it is usually priced in. The edge comes from seeing something that others don't see, or being willing to act on something that others see but are too scared to act on. Right now, China, small cap value, and clean energy are deeply uncomfortable trades. The news is bad. The price action is ugly. The consensus is bearish. And that is exactly why I think they're among the best opportunities in the market. I've made billions of dollars buying what others are selling. I've built my entire career on going against the crowd when the setup is right. And I am applying that same approach to these three sectors. Now, the risk-reward is exceptional. The setup is as good as I've seen in years. And when these trades work, as I believe they will, the returns will be substantial. The only question is whether you have the conviction to act on this information or whether you'll do what most investors do, which is wait for confirmation, wait for the headlines to turn positive, wait for someone else to tell you it is safe to buy. By then, the easy money will already be made. The best returns always go to those who act when it is still uncomfortable, when everyone else is still afraid. This is how real wealth is built. Not through comfort, but through conviction. Not through following, but through leading. Not through waiting, but through acting. And that is exactly what I am doing now with these three beaten down sectors.